with Senator John Kennedy, which is really Senator John Kennedy really get it. To be honest with you, he understands what's going on, and he really trying to get the Fed chair to say what's really going to happen. So let's get this straight, get this going. Let's listen up.
For being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
Okay. If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you.
That's exactly what he's trying to do. That's exactly what he's trying to do. He's saying he's not trying to trick him, but this line of questioning is trying to pull something out of the Fed chair that he really don't want to say. So just keep listening. This is probably, out of all the testimony that was done the past couple of days, this is the best part.
You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate. I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right, let me put it another way, okay? The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4% and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again, blame anybody, but if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight, but the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Okay.
Sir?
It could work out that way.
Yes, sir. Thank you.
All right. Key takeaways. Gotta get so the Fed, like he was saying, like Federal Chair Jerome Powell was trying to say, like, hey, I don't wanna. He didn't want to say I gotta get unemployment up, right? He's saying I need to cool supply off, because when you have a supply, basically when everybody got a whole bunch of money, people spend money, they consume, they buy up goods. So when you buy up goods, the only way to stop those goods, like if I'm selling something to somebody and I keep selling out, then obviously then I raise my price, and I keep raising my prices until I stop selling out, and then you find like a stable price. Okay, they are willing to pay this much for it. Well, when all the stimulus money came, and now that we have people making more money on jobs, like the wages have gone up, so people are consuming at a crazy rate, right? So the only way to cool that off, so they're raising interest rates, which is which is causing like companies to start to, because they still want to make profits. So and wages have gone up. So you're starting to see it in the tech industry. They're laying people off, right? So so the Fed chair is saying, like, basically, my job is price stability, and we can do that by trying to cool off, by manipulating supply and demand, basically, right? We need to cool. Right now, people have too much money. They buying up too much stuff. And the only way to do that. And so the senator is saying, like, look, you got to get unemployment up, right? Because if people are unemployed, then they don't have as much money. And if they don't have as much money, then they can't consume as much. And if they can't consume as much, then that'll bring the prices down. That'll bring inflation down. That was the best exchange out of what you saw over the past couple of days. Everybody else was up there grandstanding. I seen some of the other ones talking about, everybody try to talk about their district and whatever. Jerome Powell is looking at numbers. Whether you agree with what he's doing or the job that he has done to this point, he don't care. I ain't gonna say he don't care. He can't care, to be honest with you. To do his job properly, I don't believe he can care about what's going on. Let's see if we can. All right, now we got the screen up. So let's take a look at the market and what we got going on today. Basically, now the market opened. Oh, it's getting nasty right now. The market was flat mostly all day today. It was up a little bit earlier. Now it's getting downright nasty. So we got the S&P 500 futures down almost 1%, 0.83%. We got the NASDAQ futures down about 88 handles. The Dow futures are down. We got the Russell futures down. The Russell is leading the way. The Russell is down almost 2% today. And I am short the IWM, which is the ETF of the Russell. So we can take a look at that. Now look at this. You see my Fibonacci levels, they have been on point. I've been calling this out for the past couple weeks, right? I got a position on right now that I'm short. I put this on, I don't know, maybe a couple days ago. I took in $1.24 in premium, and right now it's worth about 40 cents almost. Basically $40 if I wanted to close it out. But we're gonna hold till it gets down to this level right here. So I told you it hit the 61.8% level, hung around right there. We now are at the 100% level. That's your AB equals CD on your Fibonacci extensions. And we got our next level is down here right around 178. And I will hold this position probably until then. The Russell is leading the way down. So I know we talked about earlier with the video when he was talking about uh, bringing inflation down, and their mechanism for doing that is raising interest rates, right? So what that has done to the bond market is initially we had the bond market selling off. Now, right here, what you're looking at is the 10-year. You see it dropping down. Let's go look at the 2-year. You see the 2-year coming down, right? Now, it had caused the 2-year yields to bump. Look at the 2-year yield, right? So here's that high that I put up and then took that out. And so yields have been going up. You can look at the 10-year yield. It's right there. It hasn't quite broken out and taken out this high yet. So when the yields go up, that is the opposite of the bonds. You got the bonds down. I had a short position in the note as well. I sold the call spread in here. So that's as long as interest rates are going up, you got to look at the stock market that we've had the past really since the housing market crash of what was that, 07, 08. If I was to go back, I'm gonna look at the S&P 500. We're gonna put this on a weekly, and we're gonna go back. Let's go back 20 years. Look at this. If we were to go back 20 years and go all the way back, see, look, you can see right around in here. This is 08. We got the housing market crash, right? Here's where they came in, and we started, you know, what they call quantitative easing. And basically from there, from 2000, you could really call it 2009. Look at the market. I'm going to draw this all the way out, but just look at the market. Now look at it. You can really see it like that. Just an upward trend ever since then. Now, right here, you see this big spike right here. This is COVID. COVID, you got a nice correction. And then even after that, once they started lowering rates and even they kicked it into high gear with stimulus and everything else. Just look at what happened. So we're just now getting down to like the COVID, but the pre-COVID was right here down on right around 3,400 on the S&P 500. We got her down around that level, and then we popped again. But to get back to just pre-COVID, you got to get here. If to wipe out, really, they got to correct back, if you ask me, back around to like the 2010 levels. Now, they may not try to do that because that really would send us into a depression. I think we're going there anyway. I just don't think there's no way around it. You mean to tell me basically they got to get unemployment they got to get it up to, from what I understand, from what the senator was saying, 10% to get this back down to the levels that it was at. You got to get unemployment at 10%. What happened? What does 10% unemployment look like in this country? What does that look like? Forget about the stock market. You just think about what that looks like. Think about the housing market is already feeling it, right? So with that being said, the whole reason why this is, I bring that up is, in my opinion, you want to be short. Now, I'm short. I ain't long nothing. I'm just being honest with you. If I, not even my 401k, I ain't long nothing. I'm sitting in cash. I think I take, to be completely honest, I think a small percentage of it is in like some type of fixed income or something like that, right? It's a small, all what I couldn't transfer to self-directed, and I'm just sitting in cash, right? I have a job. I just take my match and I just sit on it and I just save it. That's just me. I'm not. This is not financial advice. You know, don't do what I say. I'm just laying out some evidence and some facts that the Fed chair did not want to say 10% unemployment. He didn't want to say it. Hell, even if you don't say 10% unemployment, 8% is bad. 7% is bad, right? He didn't want to say it. And good, that was, to me, I don't get into politics a lot, but I think that was a great job by the senator of drawing out valuable information, man. You can come up there and grandstand and do all the, people don't get anything out of that. If you was watching that, he made Jerome Powell feel uncomfortable. You could tell he started moving like, he started, stuttering a little bit. But luckily, you guys got me, right? Because while the market's going down, we can put positions on to take advantage of this down move. Let's look at Caterpillar. All of these Caterpillar, IWM, and Netflix, I've been on these for the past few weeks, giving you guys like, look, this is what's going on. Caterpillar. The only thing about Caterpillar, the liquidity is not where I like it. So we got earnings on April 27th. We can put something on 43 days, but you got $10 wire strikes. I don't want to be in $10 wire strikes. Even if I sold the 250, right? Bought the 260, that's gonna give me that's good juice though. 345. I just don't like $10 wire strikes. Um, I would go to 36 days if I could. Sell the 255, buy the 260 for 135. What does that look like? So basically, my short strike is here. Um, there are other ways, like, because I do believe that it's getting down to 230. So other than that, let's take a look at something else. Let's say, we wanna target 230. We could do a put spread. We could buy that. We could buy that. Buy the 235, sell the 230, pay 125 for it. Or what is the or if we bought the put spread, bought the butterfly, did something like, so it's $10, what is that, $15 wide, broken wing, that's 340, pay 340 with a max profit of 1100. You got a 57% chance of, eh, that's not bad. I'm gonna continue to look at this. If I put something on, I'll show you guys what I put on. I'll make a post and post it to the community. So anybody that has joined, if you join, and for $9.99 you get, I show my trades to those people. So you'll be able to see if I put something out. But ideally, I like Caterpillar being short, and you can just buy the put 315, right? If you get in the money in the next, I just don't like, it's the theta decay on this. It's gonna decay like crazy, right? You need to get this move. You need this move in a week to really make some good money. I would say maybe 2 weeks. You need to get that move before 23 days. You got about 13 days to get that move before the time decay really kicks in, like right around 23 days. And so you're going to lose the value of your put. But if you buy it, if you get that move in 13 days, within that, you could probably double your money at least in the money put. And that, the way you see that is In the money put at 230 right here is gonna put you. You're gonna be at about $800. So if I went to, let's say, 36 days, now let's go to 22 days. That same in the money put is worth anywhere between 660 and 685, right? So this is how you can use the option chain to see how much. So you would double your money. So you needed the bank in 2 weeks. And is it possible? It's possible. What's the expected move? I would say what I would do is look at the 15-day expected move, which is $10. So I would probably buy the 235. Let's look at the 235. How much does that one be? This one would probably be the better option to buy if you want to get in the money within the next 2 weeks. And you guys see how I did that? I used the 15-day expected move of $10. So in 15 days, $10 from here will put me at what, 233? So that I will use by this strike. It'd be right in here, right in between here, but we don't have a dollar wise strike. So I would probably buy the 235. So that's how you use the option chain to kind of see, to price out your options on what they would be worth. Um, let's see. You look over here at the advanced decline. We got two. Let's look at this on the chart. Yeah. So the majority, you see how just the majority of the stocks in the S&P 500 are down now. I don't know if some kind of news came out. Some news must have came out while we were looking at look at the IWM. Next stop 178, baby. So now I don't know if it's gonna keep. I got another level down here. I don't know if it's gonna make it to this level or not. And we do have a jobs number tomorrow, so I would be careful day trading tomorrow. Now I did do some zero DTE trading today too, so I might as well go over that. Let's go over the. Yeah, I know you've been hearing a lot about the zero DTE, 0 days to expiration. That's this right. That would be this one right here. So basically, what I do, and you can see today, I sold a credit spread for 135, bought it back for $70. All right, I made $65 on it. But I was in and out. Just something quick. I ain't trying to hold them to the end of the day. But basically, all I did was, um, now you see this ruler. Now, as far as I know, TastyWorks is the only network that has the little ruler on the option chain, and where they figure out based upon um, the at the money. I think the at the money bid ask, and I think the two or three outside the out the money at the money. So it'll probably be this one. I think this one, and then this one, and they calculated this ruler part, right? Their expected move. You can go on Tasty Trade, I think on their website, and you can search Google how they figure it out. But I like to use that, and I pick a side, right? I look at the chart, and if I see it start to go down, I sell this side right here, and it went down, and then I get out. I don't hold it to the end of the day. I just, it's for me. Today was actually a little slow starting out, and so I was just trying to do something while I was working on a video, do something to stay busy. And so I do something like that. Um, Me buying, coming in here and YOLOing, that ain't really my style. You got to be careful with trading these 0 days to expiration. So when they say it's just gambling, it's not to me. Even though I do think gambling and trading is closely related, um, but there is strategy to it, right? Like as you can see, I'm using the expected move to trade around that. Another way to trade it is to get outside the expected move. So you say the market gonna bounce around in here, should come out here. You can come out here and sell one standard deviation. Boom. Right now, if you sold this right here, you can still take in, we'll lock it in, another 135, and just say that the market is going to close within this area right here. You could do that. Um, So I like this. I like this particular set. I actually like this. I'm not gonna put this on though. I already traded one of these. So you could do something like that, or you could just pick a side and sell this side and say, hey, it ain't gonna come up above this, right? Um, or you could come down to this side and sell this side. Or if you just want to be long it, you can come buy. Now, I wouldn't buy the SPX. It's a little bit expensive. If you were gonna do it, you could come to the SPY if you wanted to buy options and pick a side. But just remember, when you buy options, you're buying, um, you're buying theta. Basically, that option is gonna decay, so you need your move. You got it. If you bought a put today, you did get that move. Now I don't know how much time value came out of it, depending on when you bought it. But if you look at it, it's not a whole lot that they're saying that's going to be in the rest of the day, right? So just keep that in mind. You pay $100 for this. How much is it going to move for you to make, any more money? You do better off, in my opinion, of selling the range. So hey guys, hit that like button, hit that subscribe button. I went a little longer than I normally do, but I really wanted to cover uh, Jerome Powell and that exchange he had with Senator Kennedy a couple days ago. I thought that was really valuable information, and I may come back with another video tomorrow. More than likely, yes. And I may get something going tonight. I got something I'm working on, trying to give you guys more content. And with that, I'm going to be out. Peace.